Hi, welcome to lesson 5, guys. So in this lesson, we're going to learn our first strategy, which is the impulse pullback strategy with 15-minute candles. So far, we've covered a lot of the basics. So you've learned about what's a positive statistical expectancy or an edge in the markets and how we create it with technical analysis. About reading trends, support resistance. You've also learned about how to size your positions and how to ensure you've got a good risk-return ratio. So in this lesson, we're going to put everything together into a strategy with specific entry and exit rules for you to follow. So let's begin. First, an introduction about the impulse pullback strategy. This is one of the core strategies that I trade personally. It's one of my bread and butter strategies. So this is a strategy that seeks to go long on FX pairs that have pulled back after just starting a new uptrend, and we go short on FX pairs that have just pulled back after starting a new downtrend. So in other words, if we want to go long, we are looking for a new uptrend signal, a short-term uptrend signal, which I'll show you how to detect in a while. So for example, over here, we've got this uptrend signal that tells us there's a new short-term uptrend, and we don't enter right away. We wait for a slight pullback based on the candlestick patterns. That's a bit of early profit taking. And once we see that pullback, we place our buy order somewhere over there to catch the next impulsive wave going up as the trend continues. Similarly, if we want to go short, we're looking for a signal of a new short-term downtrend over here. So that's a new short-term downtrend. And again, we wait for a minor pullback or retracement from the candlestick patterns. And we place our sell order over there to catch the continuation of the trend, the new impulsive wave going down. So again, we're going to go into the specifics in a while. So time frames, this works the best on M15 candles, 50-minute candles, and the trade duration is usually less than 6 hours. In fact, most of my trades last for 1 to 3 hours, most of the time, right? When you get in within 2 to 3 hours or 1 to 3 hours, you hit your profit target or your stop loss. And rarely will it go on for 6 hours. And even more rare will it go on for more than 24 hours. It usually will end within 24 hours. So it's a day trading strategy. Now, how often do these setups appear? These setups can appear quite often, but I only take the high probability setups, which I'll tell you how to identify. And for these high probability setups or trades, I would say an average of 10 to 15 a month for this particular strategy, okay? Now, this works on all Forex pairs of major currencies. So again, you've got the pound dollar, the euro dollar, dollar yen, dollar franc, dollar CAD, Aussie dollar, pound yen. So any of the 8 major currencies and the different pairs that they create, okay? Now, understand that in this strategy, we're going to have a pretty tight stop loss of about 8 to 10 pips and a profit target of about 13 to 15 pips. So because of that, we have to use Forex brokers with very tight spreads, or we only trade when the Forex pair has a tight spread of ideally, 1 pip or less, or at the very most 2 pip spread. But beyond 2 pips spread, it's not ideal to trade this strategy. Okay. Great. So that's an introduction of the impulse pullback. Before we go into the actual strategy, okay, you have to understand some candlestick price action definitions, right? So let's take a quick look. So first of all, let's look at the context of an uptrend. So on an uptrend, ideally we're going to go long, okay? And of course on a downtrend, we're going to go short. So let's talk about going long first. And again, going long, recall, means we are buying. We are buying the currency pair and we're going to sell at a higher price, okay? So first, understand that what it means to have a pullback candle, okay? So the definition is such. A pullback candle is a candle that makes a lower high and a lower low versus the previous candle, okay? So over here you can see that, right, the price is going up and we've got this bullish candle over here, okay? And what happens after this bullish candle is we have a pullback candle. So this red candle is a pullback candle. in relation to the previous candle. So why is it a pullback candle? Again, what's the definition? Right, this candle makes lower highs. Can you see? So this high over here to this high, it makes a lower high and a lower low. So that's a pullback candle. All right. Now, in this case, the pullback candle happens to be a red candle. Now, it doesn't have to be a red candle. It could be a red candle or a green candle. Okay. So the color is not important. What's important is the lower highs and lower lows. Got it? Great. So that's a pullback candle when you're going long. Now, what's an inside bar candle? Now, bar and candle is actually the same thing, right? It's used interchangeably, right? So inside bar or inside candle is fine, yeah? So an inside bar is a candle that makes a lower high, but a higher low in relation to the previous candle. So a slight difference, right? So again, we have the price going up, we've got that bullish candle, and then we have an inside bar. So why is this called an inside bar? Because it makes a lower high, but a higher low. So think of it as this is like the mother candle, right? The green is the mother candle, and this candle is the baby candle. So the baby candle, the entire range of the candle is within the range of the mother candle, right? So it's like a little baby. So it's inside the mother. So it's called an inside bar, okay? Great. So that's for uptrends. Now, if we're going on downtrends, we're going down, right? So similarly, on a downtrend, pullback candle is a candle that makes a higher high and a higher low versus the previous candle. Okay? So again, we're going down. So there's a downtrend and we have got this red candle. So after this red candle, we have a pullback. It pulls back before continuing down. So again, why do we call this a pullback candle? Because it makes a higher high and a higher low, right? In with relation to this candle. So there's a pullback candle. Okay. Once again, an inside bar in this case is a candle that makes a lower high and a lower low versus the previous candle. So once again, we've got that downtrend. This red candle is towards so-called the end of that downtrend for now, and we've got an inside bar that appears, right? So inside bar is again lower high and higher low. So again, imagine this is the mother, and we have got the baby contained within the mother's body, or within the mother's range, okay? So ensure you understand these price action definitions before you go further. If you don't, please review it, send me emails, ask us questions. If you've got doubt, we're happy to clear it up for you before you move on, all right? Okay, let's move on to more candlestick price action definitions. Next is to understand what is a bullish pin bar. Okay, so a bullish pin bar is a specific candlestick pattern where the body of the candle is really small. So take a look at these four candles. 1, 2, 3, 4. All four of them qualify to be bullish pin bars. Why? Because they have very small candle bodies in relation to the entire range, right? And you can see that in these two cases, the candle body is just a line, right? Because the opening price and the closing price is the same price, so it's just a line. So that's the first definition. Body has to be small. Next, there's little or no upper shadow. So notice that there's no upper shadow, or there's only a very small upper shadow. Okay, so all four qualify, okay? And here's the important thing. The lower shadow has to be long. So for a bullish pin bar, you want a small body and a long tail, a long lower shadow. Think of a little sperm, right? Okay? And again, what is long, right? So long means the lower shadow or tail has to be at least 2/3 of the range of the candle. So this is just an approximation. So in other words, remember that the range of the candle is the top to the bottom, right? That is known as the range. Let me just draw that. That's the range of the candle. Okay. So what I'm saying is that the lower shadow, which means from here to here, the lower shadow has to be at least 2/3, roughly 2/3 of the entire range, which would obviously be 3 out of 3. So about 75% of the range should be the lower shadow, okay? So, I mean, doesn't it look like a pin, right? Like it's a pin where you poke something, right? There's a pin, right? So we call this a bullish pin bar. And we look at bullish pin bars when we're going long, because bullish pin bars are good indications of bullish reversals. In other words, after a bullish pin bar, there's a highly likelihood that the price would tend to move up, okay? So understand what's the psychology behind this. Is because imagine this is a bullish pin. Again, the color doesn't matter. It could be a green candle or red candle, right? What's important is the shape, okay? So imagine this was, for example, a red candle, right? So there's the opening price here, and there's the closing price here, right? This is the high, and this is the low, right? So why does this tell you that the market is becoming a bit bullish? Why? Because what it tells you is that the price opens here at this level, okay? And when the price opens, it is pushed all the way down to this low by the bears, right? So the sellers push the price all the way down, attempting to push the price down, but the price is pushed back up by the bulls, right? So the buyers push the price back up so that it closes near where it opened. So it tells you that the price attempted to go down, but was rejected from lower levels. In other words, the bulls began to take control over the bears. The buyers are now controlling the sellers. So that is why we tend to have a price movement up after a bullish pin bar. Again, it doesn't happen 100% of the time, but over a large sum of trades, it gives you an edge in the markets. Okay, so there's a bullish pin bar. Now, related to the bullish pin bar is what I call the bullish ice cream bar. Okay, so think of it as it looks like an ice cream stick. So this and this, they both qualify to be bullish ice cream bars. So this is a candlestick pattern where the lower shadow is at least 50% of the range of the candle. And once again, there's little or no upper shadow. Okay, so again, what's the range? So this is the range of the candle. That's the range. Okay, and that's the lower shadow. So to qualify, again, this lower shadow over here has to be at least 50% of the range. So in other words, half the candle must be the lower shadow. Okay, so same thing over here. And again, notice there's no upper shadow or a very small upper shadow, right? So this qualifies as a bullish ice cream bar. So again, please understand the definitions before we go on. Okay, now when we're going short, we look for the opposite candlestick patterns. We look for a bearish pin bar and a bearish ice cream bar. So it's the same thing except flip it over. So again, a bearish pin bar is defined as a candlestick pattern where the body of the candle again is very small, right? So again, small body, so on and so forth. So all these four candlesticks qualify because they've got small bodies, right? And again, the color doesn't matter. It can be a green or red candle. Doesn't matter. It's a shape. For bearish pin bar, there's little or no upper shadow. Oh, sorry, there's a bit of a typo here. There's little or no lower shadow. Okay, there's little or no lower shadow. Right. So again, notice there's no lower shadow. It's a very small lower shadow, and the upper shadow. All right. So there's a typo here. The upper shadow, in this case, upper shadow is relatively long. Okay, so you've got a long tail, up tail, and a small lower tail. Okay, so again, it's a sperm swimming down. Remember that, right? A little sperm swimming down. Okay, so again, how do you define? Again, if you take the range of the candle, right? That's the range, the top to the bottom. That's the entire range of the candle. So once again, ensure that the upper shadow is at least 2/3, or about 75% of the range of the candle. Okay. Now, similarly, the bearish ice cream bar is a candlestick pattern where, again, now the upper shadow is at least 50% of the range of the candle, right? So again, notice that the upper shadow makes up half of the range, okay? And there's little or no lower shadow. Okay, so get that definition clear, and then we're going to move on to the specific entry and exit rules. All right, so let's take a look at how we set up for a long trade. So the first thing is when we're going to go long, we're looking for a new short-term uptrend. And we identify a new uptrend by the 6 EMA, the 6 exponential moving average, crossing above the 18 exponential moving average, right? So again, new uptrend is signaled by 6 EMA crossing above 18 EMA. So over here, let's take a look at this chart, right? So this red line you see, that's the 6 EMA. And the blue line is the 18 EMA, okay? So we want to see the 6 crossing above the 18, signaling a new uptrend. Now, once a new uptrend is signaled, we want to see an immediate corrective pullback after the uptrend. So the candle immediately at or after the crossover signal is known as the swing high candle. Follow me for a while, okay? And the next candle after the swing high candle must, I say must, make a lower high for it to be a valid setup. And this lower high candle could be a pullback or an inside bar. Now, let me draw it up for you so you can better understand. So what I'm saying is, so we want to see the 6 moving average, right? There's a 6 EMA crossing above the 18 EMA. So that is the signal of a new uptrend, right? Now here's the really important part. Right at the cross, okay, it says here, right? So it says here, the candle immediately at or right after the cross over is known as the swing high candle. So in other words, right at that cross, we need to have a candle that appears, and we call this the swing high candle. And this candle should be the highest point right at or right after the cross. Okay, so in other words, right before the swing high candle, you see a series of candles before that. And again, this candle needs to be the highest high of all the recent previous candles during this upward move. Okay, so that's a swing high candle. And what does it say next? It says the next candle after the swing high must make a lower high for it to be a valid setup. So in other words, after this swing high appears, the next candle must make a lower high. So it could be a pullback candle, right? So it makes a lower high and lower low. So that qualifies as a setup, okay? Or so in this case, it's a pullback. Remember pullback, lower high, lower low? Or it could be an inside bar that appears. That is also allowed. So after the swing high candle, you have got a inside bar that appears like that. That makes a lower high, but in this case, a higher low. So that's also a qualified setup pattern, okay? Now, the most important thing to understand about this strategy is that the swing high must strictly appear only at the cross or right after the cross, but no later than that. If it appears any time later, it is no longer a valid trade. Okay, so let me give you a few examples here. Let me just rub this away. Okay, good. So let's imagine in this case, the 6 crosses above the 18, and then we have got this candle over here. Okay, so you may think, hey, that's a swing high candle, right? Because it appears right at the cross, right? Right at the cross, right? Okay. Now, what happens if after this candle, we have another candle that goes up? Okay, so this candle now becomes the swing high candle. Why? Because it's making a higher high than the previous candle. So it's a new swing high. Okay, so is this swing high allowed? Yes. Why? Because it comes right after the cross. Remember, right at the cross or right after the cross, but no later than that. In other words, after this swing high candle appears, let's mark this as a swing high candle. After this swing high candle appears, the next candle must be a pullback candle, or it must be an inside bar candle. If it is not, we do not take the trade anymore. So in other words, if it happens that we have another candle that makes a new higher high, this is not allowed anymore, right? Because remember, what's the strict definition? The swing high candle must come right at the cross or immediately after the cross, but no later than that. Okay, so please understand this concept. It is really, really important. So in this case, let's take a look at this chart. This is the pound dollar. Again, I'm looking at the 50-minute candles. Okay, so notice that we have got the cross over there, right? And right at the cross, we have got the swing high candle. So this is the swing high candle. Can you see that? That's the swing high candle because it's right at the cross, and right after the swing high, we have got a pullback candle, right? That makes a lower high and a lower low, right? That's a pullback candle. So there we have got the long setup. Okay. Now, I usually want to have the pullback candle or the inside bar to be a bullish pin bar or an bullish ice cream bar. Okay, because that gives me more confidence that when I have a bullish pin bar or bullish ice cream bar, it's going to move up after that. Okay, so in this case, is this a bullish ice cream bar or bullish pin bar? Right, again, remember what I taught you earlier. That's right, it's a bullish pin bar. Okay, so once I have got either a bullish pin bar or bullish ice cream bar, I'm able to now take the trade. Okay, and this latest pullback, okay, or inside bar, I called it the trigger bar. So the trigger bar, let me write it down. The trigger bar is the bar that I see prior to taking my entry, right? It's the last candle I see before taking my entry. So what I do is once I see this is a valid trigger bar, what do? I'll place a buy order right above the high of that candle. Okay, so you can see I'll put a buy stop order right above the high of this candle, somewhere over there. Why? So that if the next candle goes up as I anticipate, it will trigger my buy order and I'll be in the trade. Now, if the next candle doesn't make a new high compared to this candle, the pullback candle, say the next candle makes a lower high, then my order will not get triggered. Okay, so I may have to place another order or cancel the trade. And I'll talk about that in a short while. Okay, so I will then place my stop loss, and I'll teach you this more in detail in a while, but I just mention it. I'll place my stop loss below the low of that pullback candle. So my buy order is there, and my stop loss is somewhere over there. Okay. And so in this case, you can see that the next candle that appears is a green candle that exceeds the high of this candle, exceeds the high of the pullback candle. So it triggers my buy order. All right, so I'm in the trade and it goes up, pulls back again, goes up, pulls back again, and goes up and hits my profit target. Okay. So understand the concept before we move on. All right. Here's another example, and this is again on the pound dollar 50-minute candles. Okay, so let's take a look at the pattern again. So again, this red line, that's the 6 EMA. The blue line is the 18 EMA. So we've got the 6 EMA crossing above the 18 EMA. Can you see that? Okay. So remember, right at the cross or right after the cross, we must have a swing high candle. So which one's the swing high candle? And the answer is this guy, right? This is the swing high candle. Why? Because it appears right after the cross, which is valid. But no later than that. No later than that. It must be right at or after the cross. So that's a swing high candle. Okay. And again, notice that it is the highest high over the last series of upward candles. So it is a swing high. Now, what must happen right after the swing high? Remember the rules that we said here? The next candle right after the swing high must make a lower high for it to be a valid setup. It could be either a pullback or an inside bar. Remember that? Okay, good. So, right after the swing high, what do we have here? We have got a pullback candle, right? Because it makes a lower high and a lower low. So we have a pullback candle, so it's valid. But would I take the trade yet? No. Why? Because I want to see, again, either an ice cream bar or a pin bar. That gives me higher probability. So I will not take the trade yet. I will see what happens next, okay? So what happens next is after this pullback, I have another pullback. I have another pullback, right? So again, it makes, so why is this a pullback? Because it makes, again, another lower high and lower low relative to the previous candle. So, and now this pullback candle happens to be an ice cream bar. Ta-da! I have an ice cream bar. So again, I need to have a pin bar or an ice cream bar, and then I've got my trigger. So this will now be my trigger candle. Okay, good. So once I've got my trigger candle, I can place my buy order. I place a buy stop order just above the high of this candle, waiting for the price to move up and trigger my buy order in this case. Okay, so as you can see, the next candle indeed went up and triggered my buy order. Boom, I bought it here and it's going up, hitting my profit target somewhere over there. And again, I'll tell you where to place the stop loss in a short while, but my stop loss is somewhere below the trigger candle, which is the ice cream bar. Okay. Okay, on to the next example. So this is pound franc. This is 50-minute candles, and again, let's take a look at the pattern again. So over here, we have got the 6 crossing above the 18 again, the red line crossing above the blue line, and again, right after the cross, we have got the swing high candle. Can you see? So that's a swing high candle. Okay, and right after the swing high candle, what must happen? That's right, you must have a pullback or an inside bar. If the next candle makes a new high, it's not a valid setup. So in this case, right after the swing high candle, what do we call that? That's right, that's a pullback. Why? Because it makes a lower high and a lower low, right? So there's a pullback candle. So can we take the trade? Not yet. Why? Because again, I like to see either an ice cream bar or a pin bar. So I have to wait to see what happens next. So after this, we have got another pullback, right? Another pullback appears, makes a lower high and a lower low. There we go. And lo and behold, it's a pin bar. So now that we've got a pin bar, we can take the trade. Okay, it doesn't appear, we don't take the trade. And so this pin bar will be what we call the trigger candle. Again, the trigger candle is the last candle we see before we place our order. Okay, so we place our buy order, our buy stop order, just above the high of that candle. Okay, and we place the stop loss below the low of that candle. All right, and you can see that it was triggered 2 candles later. It was triggered and went up, went down, almost hit the stop loss, went up, went down, went up again, went down, almost hit the stop loss again, and boom, went up and hit the profit target. All right, so anything can happen in the markets. We're just taking a trade with a qualified setup. Okay, so once again, here are the rules for pullbacks for long setups, right? We should see no more than 3 pullbacks for a long position. So in other words, after the swing high appears, so this is a swing high, right? We should have no more than 3 pullbacks, right? Pullback 1, 2, 3. Any more than that, the trade is disqualified. We do not take the trade. Maximum 3 pullbacks. But there's no limit for the number of inside bars. So we could have many inside bars, that's fine, but maximum of 3 pullbacks. And also, we have to ensure that the price should not pull back below the 50 exponential moving average. So notice that line is the 50 exponential moving average. So as the price pulls back, it should not pull back below that. If it pulls back below that, it's no longer valid. All right? Or if the 6 EMA crosses below the 18 EMA, that is also not a good trade to take. Okay? So let me give you a few examples of how this could play out. Right? So again, let me draw. I think that's the best. Okay. So let's imagine we have got, again, the 6 EMA crossing above the 18 EMA, like so. All right? So it crosses right there, okay? And say, again, these are the candles that we see. Okay, so say we have got this candle right now. Okay, so what do we call this candle again, guys? What do you call it? That's right, this is called your swing high candle. Okay, why is it called the swing high? Because it appears right at the cross. Or again, it could be right after the cross, it's fine. Okay, so right after the swing high candle, let's imagine that we get something like that. Okay, what do you call that? What do you call this? Is it a pullback or an inside bar? It's a pullback, right? Because it makes a lower high and a lower low. Okay, so let me ask you this. Could we now take the trade? Could this be a valid trade setup? Yes. Why? Because it's a pin bar, right? So what I'll do is I'll place my buy order right above the high of the candle. So my buy order will be here, right? I'll be buying over there, all right? And my stop loss that you'll learn again later, but I'll just mention it, you place a stop loss somewhere below the candle. So this is your stop loss, right? So if the next candle goes above the high of this candle, we will get our buy order triggered and filled and hopefully ride the trend up. Yeah. Now, what happens if the next candle makes another pullback this way? So say after this pullback, we have another pullback. So your order's not triggered, right? But is it still a valid setup? Yes, it is still a valid setup. Why? Because we have another pin bar. Okay, and it's within 3 pullbacks because we only have 2 pullbacks. So it's a valid setup. So what do I do now? So in this case, I will then cancel my initial buy order, cancel my initial stop loss, and now my new buy order will be above the high of this candle because this is the last pullback that we have. We call this, so again, so initially this was the trigger candle, but it didn't get triggered, so now this is my new trigger candle. Got it? So my buy order is right above the trigger candle. And my stop loss would now be below the low of this candle. So now my new stop loss is over there. So if, again, the next candle happens to make a higher high than this candle, it goes up, boom, it'll trigger my buy order, and again, I'll be in the trade, hoping to hit my profit target. But what happens if the next candle, let's just imagine the next candle does this? Is it still a valid trade? Yes, because it's 3 pullbacks and we are allowed 3 pullbacks, not more than that. And again, the third pullback is a pin bar, right? Or an ice cream bar. So it's valid. So what happens now? So what happens now is that this now becomes my trigger candle, right? So notice that when my order is not triggered, right, and if it's still valid, I would now cancel the old order and place a new order, right? So again, I'll cancel this order, and now my buy order would be here above the high of this candle. This is my new buy order, and my stop loss would be again over there. So I keep doing this until it gets triggered or until it's no longer valid, right? So what happens if the next candle, again, it doesn't trigger, again, the price doesn't make a higher high than this candle. Say the next candle, it does this. Well, then it's no longer valid. We cancel the trade, forget it, look for a new trade. Why? Because we see no more than 3 pullbacks. Make sense? Okay, so hope you understand the concept. And some of you may say, but Adam, I'm going to place an order and cancel the order, place an order and cancel the order. It takes a lot of effort, right? Yeah, well, yeah, that's what I do. But again, another method I'll show you is that you may not want to place the order yet. You can also not place the order yet. And only when a new high is exceeded, then you place a buy limit order to catch the price as it retraces down. And that's another approach, but that's not usually my approach. So I'm teaching you my approach, which is I place the order. If it's not triggered, I cancel it, I place the next order until it gets triggered or until it's no longer valid, I walk away from the trade, all right? So this is, again, one scenario. Let me share with you a few more possible scenarios that could play out in the market, right? So let me just erase this. Okay. So again, that's my 6 EMA, and that's my 18 EMA, okay? All right, so let me show you another scenario. So say after the swing high, this appears. This candle appears like that. So is this a pullback candle? Yes, it is. Why? Because it makes a lower high and a lower low, right? So it is a pullback candle, right? We said after the swing high, there must be a pullback or inside bar. So that's fine. But it is not a pin bar. It is not an ice cream bar. So it is not a very high probability trade to take. So usually when I just see that, I will not take the trade. I'll see what happens next. So say after this candle, we then have this candle appears. Okay, so after this pullback with another pullback, but now this pullback is a pin bar. So now I can take the trade. Got it? All right. So now I'll place my buy order again above the high of this candle, and I'll put my stop loss below the low of this candle. So the stop loss will be here. All right, we see what happens next. So say after this, it doesn't make a new high, it doesn't get triggered. Say after this, I have another candle that goes like that. Boom. So now I've got a pullback, and another pullback. So I've got 3 pullbacks, right? Can I take the trade? 3 pullbacks. No. Why? Because again, this is not a pin bar. This is not an ice cream bar. So I always want the trigger candle to be a pin bar or an ice cream bar to take it, and that gives me the highest edge in the markets. You get it? Right? Okay, let me show you one more example, and then we'll move on to the short setups, right? So let me just erase that. So again, this is a 6 EMA. That's the 18 EMA. Now what I'm going to do is I'm going to redraw this a bit. Okay, so that's a 6, and say that's the 18 EMA. Okay, good. All right. And let's say this is the swing high candle, like that. It's a swing high candle. Okay, good. There we have it. Okay, good. So let's look at another example. So in this case, okay, this is not the best drawing. Let me redraw it again. Yeah, let me redraw it again. Okay. All right, so 6 crossing above the 18. There we go, and we have got, say this is the swing high candle. All right, so that's your swing high. All right. Okay, is that a valid swing high candle? Yes, it is, because it comes right at the cross, or again, it could be right after the cross. So say what happens is after this swing high candle, we have got this that comes out. Okay, so what's that called, guys? It's called an inside bar, right? So is that valid? Yes, it is, right? After the swing high, you can have an inside bar. And it's a pin bar. Can I take the trade? Okay, so I'll tell you later that if it's an inside bar, then I would require the inside bar to find support at the 6 or 18 EMA. In other words, if the inside bar appears but doesn't touch the 6 or 18, I don't take the trade. I want to see it touch. I want to see that it touches or finds support at either the 6 or the 18 EMA, and that would be a great trade to take. So again, if I see that, again, my buy order will be there, right above the high of that candle, and the stop loss will be somewhere over there. Okay? And then hopefully the next candle will make a new high, trigger my buy order, and get me in the trade. So these are all the possible combinations or permutations that can happen while you're looking for a trade setup.